Welcome to RISK66 Accelerated Training video on Collateral Requirements. I'm Tim Coomer. Let's get started. Collateral are assets that are provided as security to ensure satisfaction of a future liability. The main purpose of collateral is to set aside funding for payment of claims arising from risk. Common forms of collateral are letters of credit, cash, stocks or bonds, and trusts. Insurance companies require collateral for self-funded claims for two basic reasons: regulatory requirements and credit risk. For deductible plans, the insurer implicitly assumes credit risk. If the insured cannot pay the claims, the insurer is obligated to pay, hence, collateral is required. Regulations based on the NAIC Credit of Reinsurance Model Law do not specify how much collateral is required or how long collateral should be held. In Section 3, the model law states that the reduction in liability shall be allowed in an amount not exceeding the liabilities of the ceding insurer. Now, the key phrase here is the liabilities of the ceding insurer. The amount of those liabilities and the length of time those liabilities are outstanding are the crux of the collateral issue. Ideally, collateral terms should be negotiated before policy inception. Key elements to focus on are the initial collateral deposit for the policy year, the terms of adjustment of that collateral at policy expiration and at intervals of time thereafter until all the losses are paid. Many contracts or agreements for the security put up by the insured do not specify how the collateral will be released over time. Many contracts have no specific actuarial guidelines that will establish how ultimate losses and outstanding losses will be calculated. Term agreements between the insurer and the insured set before the inception of the coverage period can save time. They also provide relationship capital as the program matures and the required collateral levels increase. Initial collateral calculations and methodologies can vary significantly from one insurer to the next. However, the components of the collateral formula for a single prospective policy period are usually the same. The components are projected losses for the policy period, which is often referred to as the loss pick, anticipated cash flows for the projected losses, collateral installment schedule, and paid loss credit, a credit for losses that are anticipated to be paid in the first year of the policy. Factors that influence the type of collateral required include credit rating of the insured, insurance market conditions, and the risk under consideration. As an insured's loss experience matures over time, any excess collateral for a given coverage period should be returned to the insured. However, as mentioned before, many collateral contracts do not provide any details on how the collateral is to be released. Ideally, at any point in time, the collateral requirements for a program should equal the actuarially determined required reserves, as shown in the formula here below. Required reserves equals estimated ultimate losses minus paid losses. In negotiations on adjustments to the original collateral amount for a coverage period, an insured should ask for a copy of the insurance insurer's collateral work papers, verify that all parameters are incorporated correctly and that the methodology used is correct. Use an actuary to help determine the reasonableness of the loss development and other factors used in light of your organization's unique data, and inquire of the source of the insurer's factors. Also, determine if multiple methods are used to calculate ultimate losses. If multiple methods are used, review the results of each method and see how selected ultimate losses compare to the range of results indicated. Confirm that large claims are limited to the retention and are developed in a reasonable manner. An insurer will and should estimate the losses to be funded by the insured and will use those estimates as a basis for the collateral. The insured should have its own actuarial analysis to use in these negotiations. I can't stress enough the importance of quantitative analysis for collateral negotiation. A reserve analysis by coverage by year is important for collateral negotiations of the prior years. Loss projections by coverage by year at various retentions is useful for collateral negotiations of the prospective years. A confidence level analysis for the loss projection is useful in identifying the variability of the loss forecast. The insurer's loss forecast might be different from the insured's. A confidence level analysis will identify the variability and can be used to set the collateral at a level acceptable to both parties. This analysis can also help in offsetting an insurer's concerns about the insured's ability to pay losses in adverse situations. You also want a payout schedule by coverage. It's useful in the adjustment of the initial collateral, especially for lines of coverage with short payout schedules, such as property or auto physical damage. It's also useful in predicting how collateral will decline over time. A loss development factor analysis is useful in supporting the adjustment of the collateral after the end of the coverage period. The development factors are a very important element of the reserve estimate. Agreement on development factors is vital to setting equitable levels of collateral. It is important to limit collateral deposits. Periodic adjustments of total collateral based on the forecasts and payout schedules are necessary to keep the insured from over-collateralizing the risk. Key reasons for limiting the total collateral: the cost of fees for letters of credit can become significant, especially for losses with long payout schedules. An insured's letter of credit capacity will be negatively affected if periodic adjustments are not done, and the insurance company holding the collateral might become insolvent, making it difficult, if not impossible, to retrieve the collateral. An insurer is not completely certain the insured can or will pay losses, thus collateral is often required. The amount of collateral is based on an estimate of future events. The collateral is adjusted in the future based on payment of losses and development of known and unknown claims. Negotiations should address all uncertainties and include contingencies in case the parameters of the collateral agreement change. Proactive collateral discussions and negotiations can minimize the time and energy required to set and adjust collateral. Quantitative analysis is useful for collateral negotiations. They can provide sufficient information to meet financial planning and decision-making demands. An independent actuary can provide the necessary analytics to verify collateral requirements are not excessive and to help negotiate lower levels with the insurer if appropriate. For expanded information, see the resources listed along with this video or contact Sigma Actuarial Consulting Group at support@sigmaactuary.com. Thank you for taking time to watch this accelerated training video on collateral requirements.